Commodity futures markets operate through a dual structure consisting of physical metal and derivative contracts. These two components serve different functions and follow distinct operational rules, yet their interaction determines both price discovery and settlement mechanisms. Misunderstandings about how these systems interact have generated claims regarding potential delivery failures, mathematical crises, or systemic defaults. This analysis examines the structural mechanics of physical delivery, the relationship between open interest and physical inventory, warehouse operations, and the regulatory mechanisms that govern settlement. The objective is to clarify how these systems actually function, rather than how they are sometimes portrayed in simplified narratives. The analysis will proceed in 5 parts. First, the fundamental distinction between physical metal and derivative contracts. Second, the mechanics of delivery, including ownership transfer versus physical movement. Third, warehouse inventory categories and their operational significance. Fourth, the price mechanism and regulatory tools that balance physical demand with available supply. Fifth, scenario mapping based on different conditions for delivery demand, inventory levels, and regulatory responses. Physical silver exists as tangible metal stored in vaults, held by individuals, or used in industrial applications. Paper contracts, specifically futures contracts, represent agreements to buy or sell silver at specified prices and dates. These contracts serve multiple purposes, including price hedging for producers and consumers, speculative positioning, and portfolio diversification. Most futures contracts never result in physical delivery. Instead, participants close positions before expiration by taking offsetting trades, settling the profit or loss in cash. Open interest measures the total number of outstanding futures contracts. If open interest stands at 340 million ounces, this represents 340 million ounces of contractual claims, not 340 million ounces of intended delivery demand. The majority of contract holders have no intention of taking or making delivery. They entered positions for price exposure, not physical acquisition. Comparisons between open interest and physical inventory sometimes generate claims of mathematical crisis. For example, if COMEX registered inventory contains 100 million ounces, while open interest totals 340 million ounces, this creates a ratio of 3.4 contracts per ounce of registered metal. Some analyses interpret this as indicating insufficient metal to satisfy potential delivery demands. However, this interpretation assumes all contract holders simultaneously demand delivery, which does not reflect actual market behavior. Historical delivery patterns show that a small percentage of open interest results in physical delivery. In typical months, delivery volume ranges from 5–15% of open interest in the expiring contract month. The remaining 85–95% of positions close through offsetting trades before expiration. This pattern reflects the intended function of futures markets, which provide price exposure without requiring physical handling for most participants. The mechanics of delivery involve several distinct steps that differ from simple physical transfer. When a contract holder decides to take delivery, they do not necessarily receive metal shipped to their location. Instead, delivery typically involves transfer of a warehouse receipt, which represents ownership of metal stored in an exchange-approved vault. The metal itself remains in the vault under the new owner's account. Physical movement occurs only if the new owner requests withdrawal from the delivery system. This distinction matters for understanding inventory dynamics. When delivery occurs, registered inventory declines because metal has been delivered against a contract. However, the metal may remain physically in the same vault, simply reclassified from registered to eligible status under the new owner's control. Eligible inventory represents metal in approved vaults that is not currently warranted for delivery. Owners of eligible metal can choose to re-register it for delivery at any time by submitting the appropriate documentation. The flow between registered and eligible status creates flexibility in the system. During periods of high delivery demand, some eligible inventory converts to registered status as owners make metal available for delivery. During periods of low delivery demand, metal moves from registered to eligible as delivered metal comes under new ownership but remains in vaults. This flow means that the total metal in the vault system exceeds the registered amount at any given time. Delivery statistics require context for accurate interpretation. Claims about high delivery rates may reference specific months or specific contracts without clarifying the denominator used for calculation. If a particular contract has 10 million ounces of open interest and 1.5 million ounces are delivered, this represents 15% delivery rate. However, if total open interest across all contract months equals 340 million ounces, the 1.5 million delivery represents 0.44% of total open interest. The choice of comparison base substantially affects the percentage calculation. Warehouse approval processes ensure that vaults meet exchange standards for security, insurance, and operational capability. Approved warehouses store metal that can be used for delivery. The warehouse issues receipts documenting the quantity and quality of metal. These receipts are transferable instruments that represent ownership. The existence of warehouse receipts allows delivery to occur through document transfer rather than requiring physical movement of heavy metal. The legal framework governing futures markets includes provisions for what constitutes delivery. Exchange rules specify acceptable delivery forms, quality standards, location options, and timing requirements. These rules are standardized to ensure fungibility, meaning each contract represents equivalent delivery obligations. When exchanges modify delivery rules, they typically provide advance notice and grandfather existing positions under previous rules to avoid disrupting established positions. Default in futures markets has specific legal meaning distinct from colloquial usage. A default occurs when a clearing member fails to meet financial obligations to the clearinghouse. This differs from situations where delivery becomes expensive or inconvenient. High prices or tight physical conditions do not constitute default if all parties meet their contractual and financial obligations. The clearing system operates with margin requirements, daily settlement, and capital standards designed to prevent defaults even during volatile conditions. Price serves as the primary mechanism for balancing delivery demand with available inventory. When physical demand increases relative to supply, prices rise. Higher prices affect behavior in several ways. Industrial users may delay purchases if prices exceed their budget constraints or if they can operate from existing inventory. Speculative long positions may liquidate to capture profits rather than proceeding to delivery. Short position holders face increased incentive to acquire physical metal or purchase offsetting contracts to close positions rather than risk further price increases. Conversely, higher prices incentivize supply responses. Holders of eligible inventory may re-register metal for delivery to sell at attractive prices. Producers may accelerate shipments to vaults to capture favorable pricing. Recyclers increase recovery efforts as higher prices make previously uneconomic processing viable. These supply responses increase available metal for delivery. Exchange authorities possess tools to manage delivery demand and maintain orderly settlement. Margin requirements can be adjusted to reduce leverage and decrease speculative positioning. Position limits can be imposed or tightened to prevent concentration of delivery demands in single accounts. Delivery terms can be modified to expand acceptable delivery forms, locations, or timing. Emergency measures exist for extreme circumstances, though exchanges face reputational consequences if they alter rules in ways that disadvantage market participants. The regulatory framework includes oversight by government agencies, such as the Commodity Futures Trading Commission in the United States. These agencies monitor market conditions, investigate potential manipulation, and can intervene if they identify threats to market integrity. However, regulatory intervention typically occurs in response to rule violations or manipulative behavior rather than normal price volatility or tight physical conditions. Paper markets provide essential functions for commodity trade and industrial hedging. Producers and consumers face price uncertainty over the time between production decisions and final sales. Futures markets allow these participants to lock in prices, transferring price risk to speculators willing to bear it in exchange for profit opportunities. Without futures markets, producers would face greater uncertainty, likely leading to reduced production or higher risk premiums built into physical prices. Liquidity represents another critical function. The concentration of many buyers and sellers in a centralized market creates depth and reduces transaction costs. Physical metal transactions require counterparty search, quality verification, logistics arrangement, and financing. Futures markets standardize these elements, allowing rapid position changes without physical handling. This liquidity benefits all participants by tightening bid-ask spreads and enabling larger transactions without excessive price impact. Price discovery occurs through the interaction of diverse participants with different information and objectives. The aggregation of their buy and sell decisions produces prices that reflect collective assessment of current conditions and future expectations. These prices guide physical market transactions, production decisions, and consumption choices. While futures prices and physical prices may diverge temporarily, arbitrage mechanisms typically maintain reasonable alignment. The relationship between physical tightness and paper market stress involves several transmission channels. Physical tightness manifests through rising lease rates, widening physical premiums, and declining available inventory. These signals affect futures market behavior as participants assess the likelihood of delivery difficulties. However, stress in paper markets does not necessarily indicate physical shortage. Paper market stress can result from leverage, forced liquidation, or regulatory changes that affect position viability without reflecting underlying physical scarcity. Distinguishing between these conditions requires examining multiple indicators simultaneously. If lease rates rise, physical premiums widen, and registered inventory declines while paper prices also rise, this pattern suggests physical tightness transmitting to futures markets. If paper prices decline sharply while lease rates remain stable and physical premiums persist, this suggests paper market stress from leverage or liquidation rather than physical weakness. If both paper and physical indicators show stress simultaneously, the situation involves both components. Multiple scenarios exist for how delivery dynamics may evolve under different conditions. Scenario A represents normal market function with occasional tightness. In this scenario, delivery demand fluctuates month to month based on industrial cycles, investment positioning, and price levels. Some months see elevated delivery relative to historical averages, while others show minimal delivery activity. Registered inventory varies, but remains within ranges that allow orderly settlement. When tightness develops, price increases moderate delivery demand while encouraging supply responses. Exchange rules remain stable without emergency modifications. The ratio between open interest and registered inventory fluctuates but does not trigger systemic concerns. Physical premiums and lease rates show temporary spikes during tight periods but normalize as conditions adjust. Conditions required for Scenario A include diverse market participation preventing concentration of delivery demands, sufficient vault capacity and operational capability, price flexibility allowing adjustment to balance supply and demand, and regulatory stability maintaining market confidence. Indicators include delivery rates within historical ranges, registered inventory maintaining adequate levels relative to typical delivery volumes, stable or gradually declining lease rates after temporary spikes, and physical premiums compressing toward normal levels after tight periods. Scenario B involves sustained tightness requiring adaptive responses. In this scenario, industrial demand growth or strategic accumulation creates persistent delivery pressure exceeding historical patterns. Registered inventory declines toward levels that raise operational concerns about orderly settlement. Exchanges implement measured rule adjustments such as expanded delivery locations, modified quality standards, or adjusted position limits to broaden available supply. Market participants adapt by increasing eligible inventory registration, accelerating vault deposits, or modifying hedging strategies to reduce delivery concentration. Prices rise to levels that moderate marginal delivery demand while maintaining core industrial and investment flows. Lease rates remain elevated but stable as borrowing demand matches available supply at higher cost. Conditions required for Scenario B include structural changes in industrial demand or investment patterns, gradual rather than sudden tightening, allowing time for adaptive responses, exchange willingness to adjust rules incrementally, and sufficient total metal in the broader system to meet demand if properly mobilized. Indicators include steadily declining registered inventory despite eligible inventory availability, persistent elevation in lease rates without spiking volatility, gradual upward price trend without crash patterns, and measured regulatory adjustments announced with advance notice. Scenario C involves acute stress requiring emergency measures. In this scenario, concentrated delivery demands overwhelm available registered inventory during a specific contract month. Short position holders face difficulties acquiring metal or offsetting contracts at reasonable prices. Lease rates spike dramatically as borrowing demand exceeds available supply. Exchanges face decisions about emergency rule changes such as cash settlement provisions, delivery deadline extensions, or retroactive position limits. Market confidence deteriorates as participants question settlement integrity. Legal disputes emerge between parties disagreeing about settlement terms. Prices show extreme volatility with potential gaps between futures and physical markets. Conditions required for Scenario C include concentrated positioning, creating delivery demands exceeding available inventory, inability of price mechanism to balance supply and demand rapidly enough, insufficient time for orderly supply responses, and potential breakdown in clearing or settlement processes. Indicators include registered inventory approaching zero, lease rates reaching extreme levels indicating inability to borrow metal, exchange emergency meetings, or announcements of rule reviews, widening basis between futures and physical prices, and increased litigation or arbitration filings. The implications vary across participants. Industrial hedgers rely on futures markets for price risk management. If settlement integrity becomes questionable, hedging effectiveness declines, potentially forcing companies to self-insure against price volatility or reduce production. Speculative participants in futures markets assume that contracts will settle according to established rules. Emergency rule changes or cash settlement impositions may generate losses or prevent intended delivery, creating legal and financial disputes. Physical metal holders benefit from tight conditions through higher prices and increased option value of their inventory. However, extreme tightness may trigger regulatory responses that affect physical markets such as export restrictions, strategic reserve releases, or transaction reporting requirements. Vault operators face operational demands during high delivery periods and reputational risk if operational issues arise. What remains uncertain includes the trajectory of industrial demand, which depends on economic conditions and technological trends, the scale of strategic accumulation by various parties, the flexibility of eligible inventory holders to register metal for delivery when prices justify it, regulatory tolerance for price volatility versus intervention thresholds, and the adaptability of market participants to changing conditions. Key variables to monitor include monthly delivery volumes relative to open interest in expiring contracts, registered inventory levels, and trends at major exchanges. the ratio of registered to eligible inventory, lease rate levels and volatility, physical premium patterns in spot markets, the spread between futures prices and physical transaction prices, and regulatory announcements regarding rule reviews or modifications. Changes in these indicators signal which scenario is developing. The structural design of commodity futures markets reflects decades of evolution balancing competing objectives. Markets must provide liquidity and price discovery while maintaining settlement integrity. They must accommodate both hedgers requiring delivery capability and speculators providing risk capital without delivery intentions. Regulatory frameworks must prevent manipulation without over-restricting legitimate commercial activity. This balance requires sophisticated mechanisms, including margin systems, position limits, delivery specifications, and clearing arrangements. These mechanisms generally function effectively under normal conditions, but face stress during periods of extreme tightness or concentrated positioning. Historical precedents include various commodity markets experiencing tight conditions, with outcomes ranging from smooth adjustment through price mechanisms to emergency interventions and rule modifications. To summarize the confirmed elements, futures markets operate through dual structure of physical metal and derivative contracts. Most contracts settle through offsetting trades rather than delivery. Delivery involves transfer of ownership through warehouse receipts, not necessarily physical movement. Registered inventory represents metal warranted for delivery, while eligible inventory consists of metal in vaults not currently registered. Price mechanisms and regulatory tools exist to balance delivery demand with available supply. Emergency measures exist but create reputational costs for exchanges. What remains uncertain includes future delivery demand patterns, the responsiveness of eligible inventory to price incentives, industrial demand trajectory, strategic accumulation scales, and regulatory intervention thresholds. The variables that matter most include delivery volume trends, registered inventory levels, lease rate behavior, physical premium sustainability, the registered to eligible ratio, and regulatory stability. These indicators determine whether markets continue functioning normally or face stress requiring adaptive responses. This analysis clarifies that paper contracts and physical metal serve complementary functions within a system designed to accommodate diverse participant needs. Understanding the actual mechanics of this system provides more accurate assessment than simplified narratives suggesting inevitable crisis. We will continue tracking confirmed developments in delivery patterns, inventory levels, and regulatory frameworks.